Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just now to go down to the closing bell on the S&P 500 and the Nasdaq hitting fresh all-time highs here as investors weigh a potential Iran deal. Joining me here to talk about this and more, we got Yahoo Finance's Jared Blickery and Inez Ferre. Welcome both. Jared, let's start with you. What are you seeing in the markets, my friend?
Lots of records, but we got to start with the Dow as usual, and the Dow is down just a little bit here, about 200 points or 0.4%. Show you the intraday price actions. Started out in the green, have drifted into the red at the lows of the day, but we're not talking about a big loss here. Let's scoot on over to the Nasdaq. The action is in tech today, especially chips. Yes, we'll get to Micron in a second. Nasdaq up about 0.9%, and as you said, Josh, a record high. Also the Nasdaq 100, also record high for the S&P 500, also record high for the Russell 2000. That's small caps up 1.6%, and almost down the line here. Here are micro caps, another record high, I believe, for them, up 1.4%, and the list goes on. But let's get to the large cap sectors. It's been about tech today. Tech up 2.5%. That is up a considerable amount over industrials, which is still up a healthy 1.4%. Materials also up more than 1%. Those three are your leaders. Real estate also outperforming the S&P 500. But what's not working today is energy. Large cap energy down 2.5%. Staples, that's stuff you need, the retail stuff you need, down 1.3%. But let's take a look inside the Nasdaq 100. You see a lot of red here, and the mega caps are certainly not all green, but the one that counts here is Micron. That is up 2.55%. Up 20%. That is the best day since 2011. That's what it's tracking so far. Let me show you another look, market cap look, because it is now $1 trillion company. It is ahead of Walmart. It is ahead of AMD, and it is inching closer to some of the others. We can talk about that in a minute if we have time. We also have the Dow, and let's get the percentages on here. You can see why the Dow is in the red. Not a whole lot going on in terms of green. Caterpillar up 2.5%, but Chevron down 3.7%. Honeywell's in the green, but a bunch of staples and healthcare stocks, even financials, in the red here. Merck, Goldman Sachs, Home Depot, Procter & Gamble, and Walmart all off a little bit less than 1%, up to 1.8%. We can also see this in what's going on in the leaders, in that we have chip stocks at the top here. EWY is a Korean ETF, so that's heavily levered to SK Hynix and some other issues there. But in the red, we have small oil, gambling's not working, and low volatility. But for the most part, you take a look at the top line. Besides those chip stocks, we got solar, value, emerging markets, momentum, quantum trade. That's been jumping again, and home builders. So fairly diversified, I guess, in terms of the leaderboard here, but you're just not seeing it show up in the Dow.
All right, Inez, turn to you. Quick check on the oil market. Volatile, U.S. and Iran clashing. What do we need to know?
Yeah, that's right. So that complicates a little bit these talks that they have been having. But nevertheless, you are seeing that oil that is lower. I mean, Brent right now is below $100 a barrel. And just last Friday, it was at 103. You've got WTI that's also lower. You had the president over the weekend signaling that a deal was largely negotiated. Then you had U.S. strikes in southern Iran. And then you had Iran that struck a drone, a U.S. drone, and also aimed at an unmanned F-35 jet. So you have these clashes that are sort of complicating this picture, but you are seeing oil that is lower. And the Wall Street Journal also reporting that the U.S. is quietly, the U.S. Navy is shipping ships, guiding ships out of the Strait of Hormuz. So the market seems to think that net, there is optimism that you will have a deal at some point. This ceasefire, of course, it's fragile, but at the same time, you are seeing stocks that are higher, oil that is easing a bit. It's still elevated, though, of course, from when we started before the war outbreak.
And this is all happening, Inez. You know, you're just starting to ramp into the summer travel season. So what does that sort of all potentially mean then for truckers and the shippers, for the American consumer?
Well, you are seeing, you've got gasoline that's much higher than last year, more than 40% higher. It did ease up a bit over the last couple of days by about 5 or 6 cents per gallon. But But still, you are going to see gasoline that is supposed to go down over the next couple of days if oil continues to ease. You are going to see that happening, of course, with diesel as well. But you still have these elevated prices that, look, I mean, diesel is used for the last mile for deliveries. You've got jet fuel that is much higher than last year as well. So you are seeing also trends that in April, perhaps Bank of America was showing a little bit of a softening when it came to air tickets, travel. So you are seeing that there could be perhaps trips that are smaller, that are not as a long distance, but these prices are still elevated. And you've got JP Morgan that had said at some point by beginning of June, you are going to have the Strait of Hormuz open because of these critical levels that we're at, and how that impacts the refined fuel markets even more so than oil. So they're saying you could still see oil in the low hundreds, and you could still see fuels going higher in price.
Jared, back to you. You mentioned ships, but just pulling that thread a little bit more, because some of the moves you're seeing today are wild.
They are wild. Micron having its best day since 2011. I mean, that's a decade and a half. I put together a couple of charts. It's in fact my chart of the day here. Micron racing to the $1 trillion club. It is now the 11th largest U.S. public company. So let's put that on the screen there. You can see NVIDIA all the way at the left. That's up $5.2 trillion. Micron just barely $1 trillion here. Looks like it's going to be able to close that with that valuation unless something drastic happens in the final minutes here. It's basically tied with Eli Lilly and Berkshire Hathaway, though, so it could easily catapult and be, I don't know, number 8 in a pretty short order if these gains keep going up. Now, I have another chart, and let's get to that one because this shows you the returns. This is percentage returns of the stock since March 30th. That was that general market low, also happened to be the low in Micron. And guess what? All the way at the right, that's Micron. It's up almost 180%. Dwarfs anything else that you're seeing among these other mega caps. In fact, it has added $650 billion in market cap, which is basically what Amazon has added already from a much larger base. So really impressive stuff here. We're seeing this semi rally turn into a chip rally, and it's just catching on fire today.
And that's ending with you, from memory chips to performance-enhancing drugs. Enhanced Group,
yes,
which is getting shelled today. What's the story there?
It's completely getting shelled. And for people that don't know, this is a company that puts out these events where the athletes can use performance-enhancing drugs that are monitored by doctors. And their basic thesis is that these drugs are used, hormone therapy, it's used within elite circles anyway, so why not just make it transparent and see and have these events happening. Now, they had an event over the weekend, their big event out in Las Vegas. You had 42 athletes that had competed. 3 of those did not use performance-enhancing substances, and they won events. So that was quite interesting. You did have one athlete that broke a world record. That was the only world record, though, that was broken. So it's an interesting sort of company. This was their big debut event, their big event that they also streamed on YouTube. It's an interesting company because you have people who are for this, and then people who are saying, well, this goes
strong opinions
pretty
on both
much
sides.
against what everything. Yeah, exactly. So strong opinions on both sides of this.
All right, Inez, Jared, thank you both. Appreciate it. Let's get into where investors are seeing opportunities in the markets as Wall Street assesses the resilience of AI optimism. My next guest has been looking at historic parallels to this trend. Let me bring in now Ben Carlson, Ritholtz Wealth Management's Director of Institutional Asset Management. He is also author of the new book, Risk and Reward, How to Handle Market Volatility and Build Long-Term Wealth. Ben, it is great to see you. Maybe start big picture, Ben, because listen, I know you study and think about and write about notable periods in market history, Ben, the bubbles, the manias, the panics. This great AI trade and trend, Ben, that we talk about basically every day on this show, all the investor excitement and enthusiasm about that, Ben, how does it compare and contrast, Ben, to other notable periods you've studied, if at all?
Yeah, if we're just looking at the returns, it's pretty darn close to history's big time booms. So I looked at the Dow in the 1920s, the roaring 20s, the S&P 500 in the 1950s following World War II, Japan in the 1980s, certainly the Nasdaq in the 1990s. And the returns are pretty darn close. The returns for the Nasdaq 100 over the past 10 years are now better than the Roaring '20s. It's better than the S&P in the 1950s. It's catching up to the Nasdaq in the 1990s. So it's not quite there yet, but it's pretty darn close, which is kind of insane because that was perhaps the biggest boom we've seen in U.S. stocks in history.
Ben, how do you define bubble? When clients ask you, what do you tell them?
It's a hard question to answer because everyone knows when you're in a financial crisis, and when you're in a bubble, it's much harder to tell. So I guess my favorite definition of a bubble is just it's a situation where the present is impossible to morph into the future, right? What's happening fundamentally today is impossible to be explained by what will happen in the future. And so I think that's what makes the current boom so hard to handicap, because what we're seeing now is earnings growth that's kind of keeping up with the market. So if this is a bubble or a melt up, whatever you want to call it, it's probably the most logical one in history because earnings growth is there. It's not like these are just prices going insane with no backup on fundamentals. That's what makes this period so hard to handicap.
Who do you think, Ben, ultimately will reap the most rewards from this great AI build out? Will it be the Mag 7? Will it be big tech? Will it be more downstream, Ben? It's chips and software, or do you say, listen, it's just too soon to call yet?
It's funny because we've already gone through like 3 or 4 periods of trying to figure out who the winner is, right? Remember at first there was that little hiccup where people thought Google was done. And now it seems like Google is the winner. For a while, it was OpenAI is the winner. Now it's Anthropic. And so I do still think it's really too early to tell. It's hard to bet against these hyperscalers because it certainly doesn't seem like the government is wanting to get in their way at all. They're just letting them kind of do what they want. I think for a while, people thought the biggest risk to the hyperscalers was the government getting in there and breaking them up. That certainly doesn't seem like it's going to happen because we all use their products all the time. So I do think it's hard to tell who the winners are going to be. And the funny thing to me is, what's interesting about this boom compared to history is that the losers are happening faster too. So all these software stocks are getting crushed. In the past, when you had one of these big booms, people were more concerned with who the winners are. Right now, it seems like we're more concerned with who the losers are in some cases.
What's the risk, Ben, that you think maybe is overstated in your opinion? Like how should, let me put it this way, how should long-term investors, in your opinion, think about, Ben, geopolitics, war with Iran, rising oil prices?
So I think people pay attention to the headlines too much when it comes to their portfolio. And most of the time, this stuff doesn't really matter. And I think that the market actually got it right this time. I think for years, the market has overreacted to geopolitical events. And this was one time where it didn't. I think you've had a lot of analysts who were overreacting and saying, hey, we're going to get $200 a barrel oil and all these crazy things are going to happen. And the energy markets are going to go nuts. And the markets didn't really track any of that sentiment. And I think what we've realized and what markets and investors have learned over the past 2 decades is that financial crises really do matter. That has a huge impact on the markets. Geopolitical crises don't really matter as much because is it going to really impact the earnings of the biggest companies in the world? It doesn't seem like it is that much. And if it does impact, it's not a huge material impact.
Yeah, on inflation, Ben, I saw you say this. You said inflation is more personal finance problem than investing problem. What did you mean by that?
Yeah, it's funny because people look at what the inflation rate that the government puts out and they kind of go, that's not me. What are you talking? Have you seen what I spend on daycare and gas and housing and all these things? And I think no one really has that average inflation rate. Everyone's inflation rate is plus or minus something. And so I think inflation is really more a personal finance issue than a macro issue for a lot of people when it comes to figuring out how to handle it. And so it's a lot about your household consumption and what it is that you spend money on and what it is that's going on with your personal income and your investments and your financial situation. So yeah, I think it is more of a personal finance hedge than trying to figure out like what investment is going to do the best for your portfolio or this short-term time frame of inflation spiking.
You also have this line I like, Ben. You say, doing nothing is hard work. Why is that? Why is it tough to sit idle for an investor?
Yeah, I think it's harder than ever these days just because there's so much information coming at us on a constant basis, right? It's just we're drinking out of a fire hose every day. And there's so much data, there's so much analysis, there's so much information. And so I think you have to do a lot of the hard work up front and make some guidelines for your decisions, right? Hey, listen, if A happens, I'm going to do B. If X happens, I'm going to do Y. And you have to make those decisions ahead of time because you don't want to have to be making them when markets are going crazy, right? Oil goes up 60% in a matter of months. You don't want to have to be making emotional decisions under that. You want to have those decisions made ahead of time so you're not reacting, you're just following your plan.
Is buy and hold, Ben, still the smartest strategy when you look and compare it to every other strategy?
Yeah, I say buy and hold is the worst investment strategy there is, except for all the other ones. So I think it's really mentally challenging, and that's kind of the do nothing. I think this decade is a great example of all the bad things that have happened, right? The COVID pandemic, oil prices went to zero, supply chain shortages, 9% inflation, Liberation Day, all this stuff that happened, the Ukraine war, Iran war, oil spiking, all these things. And yet the US stock market is up 15% per year. And I think if you tried to sort of hop in and out at all of these different times, when things were happening, you probably did a lot worse than just sitting on your hands and buying and holding. But holding is really hard, right? I think the buying and the selling is easy. Sitting still and just letting the markets work over the long term, it's really difficult.
You also say, Ben, investors should be careful listening to billionaire market gurus. Now, hold on, Ben, because I thought I was supposed to hang on every word of Dalio and Druckenmiller and Paul Tudor Jones. Is that not right?
I think a lot of investing comes down to understanding yourself and your personality. And I think one of the great things about those guys is that they admit, listen, we are not like the Warren Buffett buy and hold investors. We are traders. We're speculators. So and I think that's one of the reasons that you get a lot of bearish bent from those types of legendary hedge fund managers. It's just their nature to be bearish. But the funny thing is a lot of their bearish pronouncements and their bearish forecasts don't match their portfolios at all. And so sometimes I think you have to watch what these people do and not what they say. And then you have to realize, listen, their circumstances are another stratosphere from normal people. And so take everything they say with a grain of salt is kind of the way I look at it.
Ben, researching and writing this book, I'm curious what impact you think it had on you as an investor. Now, do you think you came out of this experience, finished the book, and maybe, I don't know, man, you felt more paranoid than ever, or no, it was calming?
It's funny, I did the audio version of the book, and I had a producer in my ear who's not a markets person. He said, hey, as you read about all these terrible things that have happened over the past 100 years, I'm getting really anxious because, man, lost decades and high inflation and huge crashes and all these things that can happen that are wrong. But then you have to look at it and go, you know what? Over the last 100 years, all these bad things have happened and the market is still up 10% per year. So I look at it as from an optimistic point of view. I'm a glass half full kind of guy. So I think that you mix it all together, all the really bad stuff that's happened, the wars, the pandemics, the crashes, all these things, they're all tied into the long-term returns, which are still really good. So I look at it with the positive bend.
Ben, so great to have you on the show today. Congrats on the book.
Thanks, appreciate it.
As the U.S. and Iran undergo negotiations and efforts to reach a deal, the ripple effects from the Strait of Hormuz closure is not expected to have a quick resolution. Yahoo Finance's Washington correspondent Ben Worschel joining now with more. Ben, so you're right here about the Hormuz hangover. What does that mean, Ben? Break that down for us.
Sure thing. Yeah, this is a theme we're seeing a lot this week from kind of analysts in the energy industry talking about what the longer term consequences of a potential deal between the U.S. and Iran. The deal between the U.S. and Iran is a big if at this moment, still what it goes. But a reopening of the Strait of Hormuz would be a lengthy process based on these notes. Kind of three different major factors here. The first is just the sort of ships that are stuck in the Persian Gulf. There's about 1,500 ships that are currently in the Gulf, waiting to go through the Strait of Hormuz, with a question here about how quickly they're going to have the confidence to move. I think developments in the last 48 hours have raised questions on that front as well, because the U.S. strikes we're seeing in the last 48 hours are partly about mines, about Iran placing new mines around the Strait of Hormuz. So that it's going to be a lot more than a kind of turn on the Strait of Hormuz and ships go through because of how complicated this is. The second is the energy infrastructure damage that a lot of facilities in the entire region have felt. We've seen strikes from both sides there, from Iran and as well as to Iran on energy infrastructure. And the timelines you see there are months or years before those come back online. So that's capacity that's going to take a long time to come back on. And then the third element of this is a kind of low level of confidence based on the parameters of this deal we've seen about the chances of a snapback down the road. This deal that seems to be kind of in its final stages is a 30 to 60-day extension of the ceasefire with a reopening of the Strait of Hormuz and Iran's ability to export oil. That is a market positive overall for energy markets, but it's for 60 days. And what we're not seeing here is sort of any indication that either side is taking off a blockade down the road off the table completely. So this is a clear this is a deal that has a lot of positive market impacts, but a lot of questions here about how long a process of reopening will be and how sustainable this will be for certain.
Ben, how far apart now is the messaging, in your opinion, between the White House versus the analysts and economists you're talking to?
Yeah. The White House is always kind of a more positive spin on this than throughout this war, but it's kind of especially stark this week. What we heard from Kevin Hassett, one of the president's top economic advisors on television this morning was, quote, as soon as the straits are open, the energy prices are going to plummet like nothing you've ever seen before. Some of that is political spin, but that is a kind of pretty concrete promise. He also offered timelines on global refineries getting back up to full capacity of a month or two. That's really aggressive compared to sort of what you hear from the energy sector. And I think is reflective of a kind of much more unforgiving political timeline that the president's team is dealing with here. The summer driving season is here. That's when voters really can sort of feel the pinch of higher prices. And of course, we have the midterm elections in about 5 months' time. So they're really sort of they really want to be able to show Republicans in the White House show real concrete progress on these prices that currently are about $4.50 a gallon for gasoline as soon as possible. Even as you hear from the energy sector, this is a year-long process, probably.
Ben, thank you, buddy. Appreciate it.
Sure thing.
Coming up, consumer confidence falling as rising costs weigh on Americans. What it means for the retailers reporting this week. That's next on Market Domination. slew of retailers are set to report their latest quarterly results, providing more color on the price-conscious shopper. This comes as consumer confidence slips in May, with consumer sentiment sitting at its lowest level ever recorded. Here to discuss is Jerry Storch, CEO of Storch Advisors and former CEO of Toys R Us and Hudson's Bay. Jerry, always good to see you. So we did get that consumer confidence number this morning, Jerry, for May, fell to 93.1. That was from an upwardly revised 93.8 in April, did top consensus. You say the consumer is hanging in there, even with higher gas prices. Does that surprise you, Jerry, that resilience?
No, not really. Obviously, there's stress on lower income consumers. Let's posit that's absolutely true. But keep in mind, if you look at it on who's spending the money, obviously it's skewed towards middle income consumers and higher income consumers who aren't feeling the same stress. And what you're seeing overall is that consumers are continuing to spend. We have great data from April and obviously the first quarter from a lot of retailers. And the April sales data showed that retail sales were up almost 5% year over year. Some of that was gas prices going up. Strip that out, they were still up 3.7% overall. So that's a pretty good number, showing a lot of resilience and a lot of strength.
Jerry, what happens, though, if prices at the pump keep marching higher, Jerry? What if we hit $5, right? What could that mean for the consumer?
Well, I'm not sure that between where we are and $5 is the issue. I think if it went a lot higher, there would be problems. And if it stayed this high for, say, 3 more months or something like that, as you start to get into the holiday season, then you could start to have an impact overall. So we have to see what happens, obviously, in the Mideast. But if there's some solution there and prices retreat as they sort of have a little bit over the weekend and go even farther south, then I don't think that's going to be a very big issue, frankly. It's going to be one of those things where, we worried about it, didn't turn out to be a big deal, and it's over.
What about higher oil prices, Jerry, in terms of raising input costs for retailers? How do they navigate that, Jerry, in the months and quarters ahead? Do they eat that, Jerry? Do they try to pass it along to Jerry and Josh? What do they do?
Well, a combination of both, but so far they've been principally eating it, and that's because, again, it's been a generally good retail environment. Consumers have been spending the money that they have. The consumers have absorbed the price increase and still spend at the same rate they had before that. And again, keep in mind, that's because for most consumers, not for the lowest end consumers, for most consumers, when you weight them by their spending, not by just everybody counts the same, most consumers can absorb the price increase we've seen at the pump without it affecting their standard of living. That's what's going on overall. And I think if we just focus on the lowest income consumers, we see people who are really seeing a lot of stress, but who by nature, they're lowest income consumers, don't represent a high percentage of the overall spending.
I'm curious, Jerry, when it comes to AI, what are you hearing and seeing from retailers? Like how are they already leveraging this technology?
Well, there's a lot of talk about it. It's a little bit like when you're in high school and everyone's gossiping about who they're dating and exaggerating what's going on. I think there's a lot of exaggeration on what people are doing so far, but a lot of promise for the future, particularly in the back end. If you could ever, the biggest expense for most retailers is their markdowns, is products that they buy that don't sell. If you could ever get to a more perfect forecasting system, which AI holds great promise for, where you can really match supply and demand and not have to mark down all those products and have all that waste in the system, then I think you're going to see an inherent increase in either in gross margin rate or a lowering of prices that drives sales, but something really good will happen. Right now, most retailers, they're using it for kind of, back office kind of stuff that does result in some cost savings. The cost savings don't drive retail success. The top line does, demand does, and the margin rate does.
Let's talk about some specific names here, Jerry, before I let you go. Gap is reporting results this week. Stocks in the red year to date and over the past 12 months. You say Gap is a long-term keeper under Richard Dixon. How come, Jerry?
Well, I love him. I've known him forever. By the way, I was his biggest customer, I think, when I ran Toys R Us, because he was at Mattel at the time, selling Barbies. He's a great leader. He's made all the right moves. They're absolutely doing the right steps in terms of regaining fashion leadership overall. And meanwhile, he's been hiring really great people. I saw he hired Michael Francis, an Target exec just recently. He keeps bringing in great people, and that's a formula for long-term success. He's addressing the core of the business, which this is the Gap. It's the fashion. And so I believe he's going to do a great job there. He has already done a great job. That's the down payment. Now we'll see the long-term returns. What happened this quarter? I have no idea. No one does, right? That results are going to be what was expected and what they report, when they report. But over the long term, he's doing the right things to set the company up for success.
Yeah, and Richard Dixon will be on Yahoo Finance on Friday, so we'll see what he has to say. I will do, Jerry. Finally, you do sound less optimistic though here on Dollar Tree and Dollar General. How come? Is that broadly concerned about Walmart? What is it?
Well, I think it's basically first of all, I think Dollar General is the class act of that segment. And so Dollar Tree always has to face that competition. Secondly, the whole business formula, was built upon the idea that you'd have these rural enclaves that were difficult for other people to serve. But Walmart keeps attacking. And Walmart is the most amazing retailer on the planet, or one of them right now. They're doing fantastic. And so that's a long-term threat to the business model. And when you actually look at what you get at Dollar Tree and Dollar General, part of the deal was they tried to hit $1 by downsizing packaging, different things. It wasn't necessarily great value, but it was $1, and that appealed to people. And now they're breaking the dollar, Dollar Tree especially. They talk about having multiple prices now in the store, $5, things like that. Well, $5 isn't $1, so they're not a dollar store anymore. So what are they? The value isn't better than Walmart, which it really isn't, right? And if Walmart can start to serve those rural enclaves, which they've done a pretty good job of throughout their history and continue to do a greater job of, why do you exist?
Jerry, as always, great to have you. Thank you.
My pleasure.
Coming up, different ways chatbots answer questions about China, plus the Pope warning about the risks of AI. Tech support is next on Market Domination. Three AI stories we're watching right now. First, Huawei claiming a major chip design breakthrough. Pope Leo issuing a stark warning on the risks of AI, and a new report showing how AI chatbots can give very different answers on China depending on where we're calling in for tech support with Yahoo Finance's Dan Halley to break it all down. All right, Dan. So first one, Reuters is reporting China's Huawei revealing a chip design breakthrough. Now this can get wonky very quickly. So break it down simply for us. Why is this important?
Yeah, so the U.S. basically cut off access for China to certain chip manufacturing technologies, right? And so they've been basically forced to try to make do with what they have. And now they're saying that they will eventually reach almost basically parity with the best that TSMC has to offer in a few years. 2030, I think, was a time frame. TSMC says it'll have its next state-of-the-art offering in 2027. This is basically the nanometer size for the chips, which is comes down to the distance between transistors and things like that. Super small, 1.4 nanometers. I think they're trying to do. It's 2 nanometers right now. That's very, very small. Which, by the way, at a certain point, you just can't get much smaller. And so China also has this other approach where they're trying to shrink the distance between different connections within the chips. And that's a way that they can get away from this kind of Moore's law where the amount of transistors you can add to a chip doubles over every certain amount of time. And so it's kind of introduced this new kind of recognition that the U.S.'s ability to cut off China and kind of stifle its ability to innovate.
I wanted to ask you that. How much of this do you think is tied to those U.S. sanctions? Meaning Chinese companies have to say, okay, well, we're going to have to get more creative and innovative, find ways around these restrictions.
I think it's exactly tied to it, right? I mean, they wouldn't be doing this. I mean, they may be doing this if they were able to, benefit from it, or they, didn't, or they thought that there would be some kind of issue in the future with the U.S. Obviously, the U.S. went ahead and cut off access to certain chip technologies, and that's where this kind of left them. It's the same idea with the GPUs, right? They got cut off from NVIDIA GPUs. Now they're basically cutting themselves off in certain NVIDIA GPUs. So they went ahead and they said, okay, we'll try to make do with what we have and build AI models using different types of systems. Now, there's absolutely some NVIDIA GPUs in China, whether it's through smuggling or whatnot. But at the end of the day, they're figuring out how to deal with these things, and necessity is the mother of invention, and that's basically what's happening.
Topic number 2. We spent a lot of time talking about AI, two of us, as a potential business revolution. Well, now we have the Vatican weighing in, all right? The Pope is saying AI can be useful, but it's not neutral, offered some words of caution, Dan. Axios has a summary of the comments here, how AI can erode human judgment. It can simulate care without relationship. It can deepen inequality. What do you make of it?
I mean, I thought it was really interesting. I don't know who's going to listen to this kind of thing, just because it kind of would run antithetical to what all of these companies are trying to do, which is make as much money as possible. And I don't see them.
You don't think tech CEOs are taking this into account as they design a chip product?
No, I don't think so. I think some may. I think there's been some that have raised the potential threat that AI poses as when it comes to jobs or when it comes to different types of weapons. Part of that is sure it's going to impact jobs. It's already impacting certain jobs. It's also being used in war. The flip side of that is it's also some look at how scary our technology is. It's so powerful. Don't you want to invest in it? It's like kind of two sides of the same coin. But yeah, I mean, I thought it was very interesting the way he kind of described it as kind of like a Tower of Babel kind of thing, where obviously the Tower of Babel was destroyed. That's kind of the way he framed it, was people shouldn't be creating this one centralized kind of technology or centralizing it in a certain number of hands, where it should be spread out and benefit humanity more broadly. And look, some leaders of countries have said the exact same thing. I don't think that that's influenced anything. I think, the only thing that would make any of these AI companies change their way of thinking would probably be some kind of regulation. and that's basically fallen on its face. And that's been the way it's been with tech for years now. I mean, there's no cybersecurity policy really. There's no social media policy really. So what makes anyone think that AI would get any kind of treatment the same way?
Final topic I want your take on. The Journal out with a piece. Basically, people in China and the US ask essentially the same chatbot similar questions. They get very different answers, Dan.
Yeah.
What's going on here?
This is just the bifurcation of the internet. I mean, people have talked about this for a while now, saying that there's going to be a Chinese internet and everyone else internet. And so that's what this is. There's the internet that China has and the internet that everyone else has. And you can access both, but everyone else can access both to a degree, but it's just kind of creating parallel realities almost. And so with the AI chatbots, the Journal did this piece where they, and it's based on a study where if you ask certain questions of the Chinese version of chatbots, you'll get a different answer from the US based version. And if you ask Chinese questions, Chinese language questions to US based chatbots, you'll see similar results. And the thinking here is it's a result of kind of party propaganda that the Chinese government puts out, or Chinese government affiliated media puts out, kind of flooding the zone almost. And because all these companies use open web data to train their models, that's what they're pulling in. They're going to pull in everything on the internet, and that is part of the internet. And so you're getting kind of an exacerbated version of this dual internet kind of thinking, because you're literally asking questions on one and you're just getting a completely different answer from something else. And it's going to continue to be this way. In the article, they actually point out smartly that a lot of news sites and media are behind paywalls now. It's the only way to kind of survive. And so the AI can't get access to those. But when you look at what the Chinese government's putting out, that's free, baby. You can get that anywhere. So you're just scraping that kind of stuff more and more, and eventually that could lead to more problems like this.
Yeah, the article also, it does mention how DeepSeek is raising fresh capital from investors aligned with Beijing's push for technology self-sufficiency. Meanwhile, here, of course, all the hot talk about OpenAI and Anthropic and their potential public debuts. Your point is that this is our present and our future, this kind of bifurcated AI world.
It exists now. There's there's no going back. It's unless there's some kind of drastic change, this is just going to be what the world is like going forward, where you have two separate internets, and it's just not going to change. Like I said, unless something drastic happens. So it's going to get worse with AI.
Get used to it. Dan, thank you, buddy. Appreciate it. Coming up, the growth of Pressed Juicery. I'm talking to the CEO about how the popular brand is expanding and shifting its strategy to capitalize on changing consumer behavior. That's next on Market Domination. Press Juicery is expanding its footprint across the U.S., now available in nearly 10,000 stores as it grows its wholesale presence. Joining me now, we've got Justin Nettleman, Press Juicery CEO. Justin, it is good to see you. I thought we'd start here, Justin. You know, for viewers watching right now, maybe some of them have never been to a Press Juicery. Walk them through it. You know, they walk into one of those stores. What do they see? What do they experience? What do you sell, Justin?
So Press Juicery has been here for 15 years, started as a pure juicery, and over the last 5 or 6, we've expanded into wellness bowls, which is an acai-based or a protein-infused tropical bowl. We've got a dairy-free soft serve called Freeze, which is a kind of a cult favorite. And we're recently, in the last 2 years, infusing some of this stuff with really on-trend items like creatine or collagen and whatnot. So it's a juicery, but really has expanded the offering in the stores into much more. But our core business is still juice and functional shots.
You have great line of sight into the consumer, Justin. I'm just curious, how healthy and resilient does the consumer look to you based on your business versus, 6 months ago, 12 months ago?
So we've seen nothing but upside over the last year. While there's still, expensive gasoline and some inflation in the economy, our core consumer uses us as a routine. It's part of their daily ritual. It's really, I would say, not really a luxury item at this point. It's part of the routine, much like some people take supplements, whether that's our shots or our juice or other items. So we've seen explosive growth outside of our stores in the last year.
Who is your customer, Justin? Like, what's the average demo? Men, women, young, old, middle income, high income?
All over the board in our stores, and with the ever increasing growth outside of our stores in places like Costco and Target. Traditionally, we've had a female-centric core guest between 25 to 45 upper income, but it's really broadened into what we call is like the wellness curious versus just the wellness enthusiast. So people that are kind of tipping their toe into wellness and kind of trying to find better alternatives to the hardcore guests that's drinking our celery juice every morning religiously as they have been for 15 years. So the racket is really widening, I would say, in the last 3 to 4 years with who's interested in wellness, and it's kind of got a lot more mainstream from our perspective. I'm
just curious, Justin, how, if at all, have GLP-1s impacted the business? Have those new medicines sort of affected, customer behavior? Do they think differently about, portion size, for example?
That's a really great question. So in the last 2 years, we leaned hard into protein. And we believe we have the cleanest protein out there, mostly available in our stores and through nationwide shipping, but is slowly getting traction, in traditional retailers. So high protein, high fiber, calories that are healthy, rather than, low calorie, high protein. So it's affected our SKU lineup. It's part of our cleanses in our stores. And because you can get a reasonable amount of calories with high protein quickly with our protein smoothies, we almost call them meal shakes really internally. That's been a growing segment for us. So maybe that's part of the GLP-1 focus and just the protein in general focus for the consumer today.
How tough is it, Justin, to keep innovating in your business? It feels like every week you get, inundated. It's some new trend, some new supplement, some superfood. How do you kind of navigate that?
Yeah, I mean, Press is the OG. Less is more, less ingredients. We don't really want to chase trends. We want to either establish new ones or fall in line what we think is a more national thing, not just a blip in the New York or LA or whatnot. So probably the most interesting things we've done in juice in the last couple of years was adding like an ashwagandha or magnesium or L-theanine into a shot for like an evening ritual. But for the most part, our products are, nature is the show. The nature's the celebrity, not, an on-trend ingredient in a shot here or there. But we are seeing the consumer very focused on function. Like, what does this do for me beyond taste good? And calories are okay as long as it's, comes from nature and isn't added with added sugar or whatnot.
What makes somebody, Justin, choose Press rather than competition? Like, as you think through it, what's the competitive advantage there?
Yeah, I mean, Press, we own our facility. It's cold press, so it's almost as good as making it at your house or at a local juicery that might have a 1 or 2 day shelf life. So we have a really premium processing component to what we do. We think we're the cleanest beverage brand in a grocery store. We don't have any stevia. We don't use natural flavors. We don't have any glums or xanthium, this or that. So we really talk about adding things in there that you can pronounce And there's not a lot of businesses left out there that can say that. So for us, it's all about less is more and ingredients matter. And I think the consumer, whether that's because of Instagram or social media, is very informed today and asking a lot of questions of like, what does this mean? Why is this in my product? So I think that's the trend, and we've been there for 15 years. So we're very lucky to, I would say, hold true to our kind of no list. And there's a lot of things on there that possibly could taste really good, but in our opinion, aren't good for you, aren't natural, so to speak.
You are sourcing, Justin, a lot of fruits and its ingredients, packaging. Are supply chain costs becoming an issue for you at all?
Transportation is a real issue. We see that coming. We're not going to pass that on to the consumer or the guests, as we call them in our stores. We're going to absorb that, but for right now, we are seeing some cost pressure there. But a lot of our fruit is right out of California, so we're lucky we're not dealing with international challenges associated with importation. But we are lucky to be vertically integrated, which allows us to maintain margins in this kind of ever-increasing cost environment.
I am fairly disciplined, Justin, but I got to say, I was reading your personal routine. You blow me out of the water. A 4:15 a.m. wake up, endurance training, fasting. I mean, you kind of sound like your own target customer in a way, Justin. I mean, does that help you sort of run the business more effectively, more creatively?
I fully recognize everyone's on their own version of their wellness journey, as I call it. I'm to one extreme, but there's also folks that are just stepping into it. They've never done a cleanse. They've been eating unhealthy, and maybe they try our simple cleanse, which is like an intermittent fasting morning routine just to get going. I use all that fitness and whatnot just to give myself enough energy to, work hard, play hard, focus on family, be kind of at 100% all around. But I recognize, I even told folks in our office here recently, we did a whole episode on sleep for the whole support center here, that don't do what I do. Just use it as a reference to be very intentional with your time. For me, I'm lucky. I like to get up before the sun rises, but you also have to kind of know what's out there, and you want to lead by example if you're going to run a wellness brand, which is what we think of Press. We don't think of ourselves as a juice or shot business. We think of ourselves as like a wellness platform. We're selling juices and shots today, but we know it can be so much more as we grow. But that article was fun to read.
I'll end here, Justin. You say something interesting here. You say you don't believe in work-life balance. You believe in work-life integration. Walk me through that. What did you mean by that, Justin?
So I'm a firm believer that we all have to work really hard, or we choose to. And if you work on a business that you love, or in a business that you love, and a product that you appreciate and personally consume yourself, it doesn't feel like work. If I'm taking my kids to an Air One for a weekend review of what's out there, or walking through a Whole Foods for 2 hours looking at ingredients, to me, that could be work for some. To me, that's just part of my life. So wellness, fitness, mind, body, soul, it's all just part of how I live. So I always tell this to my kids. I tell it to folks in our office. We're very lucky at Press to be selling wellness. You can kind of sell anything you want, and to be using all of our superpowers to be kind of making the world a little bit healthier is really special. So work-life integration means follow your passions on what you like, and then figure out how you can make a buck selling what you're already doing, which to me is chasing wellness every day. So yeah, it's part of my life, and I love it here.
Justin, great to have you on the show today. Appreciate it. Thank you.
All right, thank you for having me.
Coming up, we have you covered through the closing bell on Wall Street. Don't go anywhere. S&P 500 and the Nasdaq ending the day higher here on Iran peace prospects. Yahoo Finance's Jared Blickery joins here with the recap. Jared.
Thank you, Josh. Tale of two markets here. We're going to start with the red. That would be the Dow. Down just a little bit, about 0.2% or 117 points. You can see off of the lows here. Last time I reported at the beginning of the 3 p.m. hour, but still off just a little bit today. But tech and chip stocks have been the story. Nasdaq Composite up to a record 1.2% there. Nasdaq 100 also a record. S&P 500 also a record, up about half of the Nasdaq, 0.6%. And the Russell 2000 small caps hit a record too. That's up 1.75%. So outsizing everything that we've looked at so far. Also want to point out the Dow Jones Transportation Index up 2%. That is a very green looking heat map. We'll take a look at that in a second. First, want to get to the large cap sectors. XLK Tech, that is up the most, 2.68%, followed by industrials and materials. Those are the only three outperformers, everything up more than 1%. And to the downside, energy was the biggest loser, down 2.7%. Staples, healthcare, and financials also finishing in the red there. If you take a look at the Nasdaq 100, you don't see the huge gains here because a lot of the mega caps are underwater, but those big gains are largely in the semiconductors. We'll take a look at that in a second. Just want to point out first, Alphabet up 1.5%, Broadcom up almost 2%, Tesla up 1.75%. And now let's get to those semiconductors. And here they are. NVIDIA couldn't do it today, but check out Micron up 19.29%, closing as a $1 trillion company, the 11th most valuable public company by market cap in the United States right now. And that is its best day since 2011. After that, we got Intel up 3%, AMD up 7%, ADI, Texas Instruments, KLA up more than 6%. A lot of outsized performers here, so I'm just going to move on quickly to software. Not having the best day. And this is kind of what we've seen most of the year. Software really not doing it on the days when semiconductors are. But I want to show you the two Dow indices. Here are the Dow Industrials, the companies that are making this stuff. Kind of a juxtaposition here. We got Caterpillar up 3%, while Chevron is down 3%. Those are the only two that I see that are above or below 3%, but a lot more red than green, as you can see. Dow Jones Transportation Index components. These are the companies that are shipping this stuff. Well, a lot of winners here. You can see United Airlines up 6%, Southwest Airlines up 3.5%. Even some of those logistic companies that you don't hear about, like XPO and Expeditors, having nice days, and UNP, the railroads, and CSX, even they're having nice days. Josh, back to you.
All right, thank you, Jared. Let's look at what investors are seeing in the markets as Wall Street wraps up the trading day. Leslie Marks joins me in the studio. She's Chief Market Officer at equities at McKinsey Investments. Leslie, it's good to see you. So war, oil, inflation, but this market keeps wanting to power higher. Why is that, Leslie? What are investors seeing that keeps them buying?
Well, it sure does want to power higher. I mean, here we are on another day with some record closes in the S&P and the Nasdaq. I find it really interesting that that's happening at the same time that we're seeing record lows in consumer confidence. And that's really showing the differentiation between Main Street and Wall Street. You know, Wall Street is looking at equities and saying that earnings are strong, and that's a reason to continue to buy. And this AI theme is going to continue to power on. And so when you're seeing all of the strength in the semiconductor space, that is really all related to the expectation that this AI theme is a durable secular theme.
Yeah, that bifurcation you're talking about, though, Leslie, it's interesting because I get that consumer sentiment is rough, but I've had so many CEOs from so many different verticals, industries, and sectors. I just had another one on today, and they all tell me the consumer's hanging in there, that they see health, they see resilience. How do you explain that?
Yeah, you know what? That's really interesting to hear CEOs say that the consumer is hanging in there when consumer sentiment is so poor. Because what I've seen across some of the consumer names, you know, you hear it from Walmart, you hear it from McDonald's, that consumers are definitely crowding out their purchases because of higher energy prices for the lower end consumer when they go to the pump. And by the way, you know, they're the ones that also see the high energy prices due to gasoline in big bold lights when they're driving down the street, is really feeling the pinch of fuel. The issue is the K-shaped economy. Like right now, the economy is still very much driven by that higher end, the consumer that's still doing well because they're benefiting from strength in in equities. So it is a tale of two markets. It's a tale of two consumers across our economy.
One stat you pointed out, which was interesting, earnings estimates, have gone from roughly 14% at the start of the year to about 25%. That is a massive jump. Is that narrow, Leslie, or is that broad-based?
Well, I point that out as, first of all, just to clarify, those are the expectations for earnings growth in 2026. So we had already expected 2026 to be a good year for earnings. I mean, 15% is a good year, and that was part of our thesis that equities would be, would have a good year in 2026. Now that we've seen Q1 report and all of the earnings surprises and revisions higher, we're now in that 24-25% range. Now, your question is that narrow? I would say it is narrow when it comes to sectors, taking it back to the consumer. The consumer staples and discretionaries continue to not benefit from those earnings revisions, but guess what? The sectors that are in the technology space, and it's not all technology. This is primarily in the semiconductor space, the memory space, hardware, not the traditional software companies that were driving earnings going forward. And then the other area, although not as big a weight in the major indices, is energy. Of course, when you look at the increase in prices year over year for energy, that's starting to really fuel earnings momentum for energy companies.
I saw that in terms of sector positioning, Leslie. You're bullish energy and materials. Is that mostly an inflation hedge?
So we think that it's really important for investors to consider the commodity space for a couple of reasons. Obviously that crosses both cyclical and non-cyclical commodities. If you think about gold, for example, being more of a financially oriented commodity, other commodities like base metals being more oriented towards economic growth, and then you have the energy complex, which would be also geared to economic growth, but also the geopolitical backdrop, which also impacts gold. So there's a whole bunch of things that are bringing together several cross currents that we think are bullish for hard assets and especially commodities. So you have the financial buyers in gold. You have people concerned about the debt levels here in the U.S. We think the geopolitical risk, even if there is a resolution or an agreement that opens up the Strait of Hormuz, of course that's going to pull energy prices back, but we don't think energy prices go back to the levels before this conflict, and that this idea of energy as a part of national security is going to continue to help the energy sector. And then finally, in the base metals space, base metals are an imperative to building out data centers or any infrastructure construction that we are planning to do in this country. So I think there's a strong story. These are more volatile investments than your typical equities, but I think the fundamental story is certainly higher over a long period of time.
So you're overweight energy and materials. What's a sector you want to avoid, Leslie?
Well, I think the consumer is still really tricky, and I think we look at the information that we're seeing around consumer sentiment, both today's information as well as the University of Michigan that we saw last week. We look at the stratification of the economy and the concentration of wealth fueling the economy. And so the consumer sectors, both staples and discretionary, I think are challenged on the demand side. And frankly, they may be a little bit challenged on the cost side due to higher commodity prices.
What's your advice to fixed income investors, by the way? They ask you, where's the opportunity? What do you tell them?
Well, first of all, let me start sort of at the very high level. When we think about the allocation between equities and fixed income right now, we're telling investors at this point in time that they should be aligned with their strategic asset allocation, so their long-term asset allocation. The reason for that is that, we've had this big move in equities. It's very much been fueled by a fundamental basis, which is the earnings growth, which is great. And we think that's going to continue through the year. But at the same time, the bond market has basically said, you know what, we're concerned about inflation. Bonds have sold off. Interest rates have risen or yields have risen, and that has actually created, a lot of negative sentiment around fixed income. And so right now, just, over the next 2 to 3 months, we think equities could consolidate a little bit here and have a harder time sort of surging higher in a broad-based way. But that fixed income that people haven't really been so focused on could actually benefit. And we're already starting to see that, yields peaked at the end of last week. Any discussion around the reopening of the Strait of Hormuz is actually helping bring some of that upward pressure off of yields.
Leslie, so great to have you on the show today, especially on set. Thank you.
Thank you.
Coming up, Ferrari unveiling its first fully electric vehicle. We'll take a closer look at the disappointing reviews for the car with a $640,000 price tag. That's next. Ferrari is making one of its boldest bets yet, unveiling an all-electric vehicle with a price tag of more than $500,000. That's hitting the stock today. Let's take a look at Ferrari on Alpha Space. You can see here, listen, it's a rough day. We're down about 6% in today's trade. But if you are an investor in Ferrari, you're used to a little red on the screen, frankly. We pull up a chart here. We'll do year to date. Let's actually take it back a little bit for about the past 12 months. You can see you're down about 10% this year. You're actually down about 30% over the past 12 months. If you go to the news here, we can also see what's been the news today. Well, it's here. It's that Ferrari announcing its new EV designed by Johnny Ive. That's taken a toll here on the stock. What's the reason for that? We're going to get into that with Pras Subramanian about that. Is that a concern about brand? Is that a concern about ultimate demand? We'll see. But listen, importantly, even though the stock, we know it's been kind of rough here, at least over the past 12 months, importantly, the Wall Street crowd was paid to give you advice on this stock. They are bullish. About 80% still say this one is a buy. For more on the new car, we're bringing in Yahoo Finance senior autos reporter Pras Subramanian. Pras, let's just start with the new EV. Walk us through it. Horsepower, price tag. What do we need to know?
That's not important, Josh.
It isn't.
You buried
what is important?
The lead, my friend.
That's why I have you
Show
on.
us the car. Show us the car. Show us the car. Please. Show us the car.
Don't
Can
get
we
to
play it?
They're working on it. They're working on it.
So the reason why
There
I
we
bring
go.
this up is because this is all that anyone's talking about. This is why the stock's down. The stock is down because people are, to put it lightly, this design departure for Ferrari is kind of a big deal. You see this here. It's very kind of, not so sculpted, more smooth lines, very Apple-esque, because this is Johnny Ive's firm, right, that did this interior.
Johnny Ive, and by the way, Praz, that's Sir Johnny Ive to you.
Correct,
right?
correct.
Johnny Ive, of course, the legendary Apple designer.
Correct.
Yeah.
His company, Love From, had the full design brief here for interior and exterior. Car comes out Monday night. Unfortunately, the design was not received well by Ferrari fans.
Why? What's the issue? What are people saying?
When they think of Ferrari, they think of emotionally driven kind of design, right? Think of like sculpted arches, low slung, wide, super aggressive intakes, hard angles, right? You think think Testarossa, right? You think F40. You think of these classic cars, the sports cars that we know about Ferrari. This is a very big departure for them. Why? Because it's an EV and it's a whole new market that they want to go to. They were originally targeting 80% new customers, right? So what do? You go for a totally new segment. You say this is the Ferrari of EVs. You mentioned statistics, right? Quad motor, over 1,000 horsepower, 0 to 60 mile per hour, 2.5 seconds. There's crazy stats. I mean, look, I bet it drives like a maniac. The underpinnings of it are unbelievable in terms of the design and the mechanical nature of it all. It's just the exterior design is kind of polarizing at the moment for a lot of Ferrari fans, and that's hitting the stock.
So the word here is demand. Is that what we're talking about? We're worried that it's not going to be the demand for this?
Yeah, I think the worry, Evercore ISI is talking about that, is that they potentially expected the fact that there would be a negative reaction to this car, but they're really concerned about the fact that, what's going to happen when this car actually comes out. They're hearing channel checks at the dealers, not much demand, right? Now, I spoke to Enrico Galliera, who's the chief commercial officer, and he said, actually, demand or reaction from our clients is very positive, both from existing clients, which he was surprised by, but also the new clients that they have not bought Ferraris. They've seen the vehicle. They're also positive on it. We'll see in a couple quarters when this car comes out what the sales are.
It's interesting, broadly, when you look at the luxury space, what have other luxury automakers, what's been their EV strategy? And how does Ferrari dovetail with rivals? Or are they breaking apart? How do you compare and contrast them?
For the most part, it's not been good. I would say the one exception is Rolls-Royce with the Spectre, because that makes sense, right? That car looks like an actual Rolls-Royce. It looks the part. It looks very amazing design. But because it's Rolls-Royce, you expect it to be quiet
Yes,
and
that's
powerful.
huge. The noise.
You don't even really think about
sound.
it. Yeah. Some people go into what kind of engine? It's like, it's no engine. It's an electric vehicle. Oh, right, because it's so quiet. So that works, right, for that specific brand. But Bentley's pushed back their EV. It's going to come out still at Perna, but pushed back a lot. Lamborghini canceled their EV because they said the CEO said next to zero demand for it, for a luxury EV. So at that level, right? Forgot to mention the price of the Ferrari is going to be $550,000. I'm sorry, €550,000 over $600,000. So couple that with the price, and you wonder, who is this product for? Maybe it's young people, maybe it's people in the East, maybe it's tech-forward people in Silicon Valley who like Johnny Ive. We'll see.
All right, thank you, Bryce. Appreciate it. Lockheed Martin is accelerating production of terminal high-altitude area defense interceptors. This comes as the company executes its multi-billion-dollar investment strategy spanning through 2030. Spoke with Tim Cahill, Lockheed Martin's president of Missiles and Fire Control, for more on the latest developments. For viewers who might not be familiar, Tim, maybe they don't live in the world of defense, can you walk us through exactly what are THAAD interceptors, Tim, and what's the problem they solve for?
Yeah, absolutely, Josh, and thank you. Good afternoon. It's great to see you here today. So a THAAD interceptor is one of our premier missile interceptors. It effectively hits a bullet with a bullet. So if you can imagine, for a high altitude, think about the edge of the atmosphere. This interceptor is deployed to destroy particularly incoming ballistic missiles. So it is an incredible part of our arsenal, built right there in Troy, Alabama, and been deployed now worldwide.
Tim, one stat that really jumps out here, you all mentioned this Alabama expansion you're going to be doing, it nearly doubles manufacturing capacity there. What does that suggest, Tim? Does that suggest we're really entering sort of a new kind of security and defense environment here?
Well, we absolutely are, Josh. I think, so first of all, we're going to quadruple production of THAAD. The facility is going to double. Now, you can imagine why we might be able to do that. You can see behind me things like production and manufacturing innovation, robotics, applying our skilled workforce in ways that we haven't before. That's how we're going to quadruple production. But yes, it is. Fundamentally, this is intended to be able to provide and sustain during an actual conflict the level of munitions that the United States and its allies needs to protect themselves effectively. These interceptors, they protect bases, they protect population centers. Ultimately, they can protect entire countries. And so this is what is necessary for both near-term deterrence and long-term to be able to keep our troops safe and to prosecute whatever conflicts this nation and its allies need to go into.
Some argue, Tim, and I know you've heard this, they'll say, listen, modern missile defense is economically unsustainable. And what they'll argue is, listen, interceptors like this, they cost millions. Drones, on the other hand, a whole lot cheaper. How do you respond to that, Tim?
Well, first of all, I think it's absolutely correct that we need a range of options from very, very inexpensive all the way up to the THAAD and the Patriot PAC-3 MSEs that we also build in order to take care of these threats. So we certainly do not advocate taking a PAC-3 MSE or a THAAD and trying to put it on a much smaller, cheaper system. These systems are effectively designed to go after the incoming threats that you have no other way to stop. What you need for the drones and some of the smaller ones are small counter-UAS systems, which we are building those as well. And in fact, we've been out in the desert demonstrating our ability to use much lower cost systems against counter-UAS and smaller threats to make that cost advantage disappear so that you're actually using the appropriate interceptor for the appropriate incoming threat.
I just want to pull on that thread a bit more with you, Tim, and just get your take on the modern battlefield, Tim, and how you just see it sort of evolving from here over the next, 5 years, 10 years and beyond, Tim. AI, drones, space. What do you see changing, and how is Lockheed well positioned to capitalize on that?
So absolutely, Josh. I think the way it's changing is a bit of what we talked about. I think these smaller drone size, for example, threats that folks might be sending our way are going to get more capable. They're going to have AI. They're going to maneuver. They're going to respond to an evolving response every single day. The same thing is going to be happening at the upper end. So those ballistic missiles are going to get smarter. They're going to get faster. They're going to get more maneuverable, you would expect. And so you have to have the incredible capabilities such as a THAAD and a PAC-3 MSE, both of which are going to evolve over the next few years to continue to handle those kind of threats as well. So it doesn't matter which end of the spectrum you're looking at. You're going to see speed. You're going to see intelligence in these weapons that you have, and maneuverability in these weapons that perhaps you had never seen before. We have to keep ahead of that curve. And that's what these systems are designed to do, is always stay one step ahead of whatever adversary is coming at you, and always keep them wondering, do they really want to attack? As you know, deterrence is what this is really all about. This is the foundation. What we hope is that these systems will never get used in a conflict. And in fact, they'll make an adversary think twice before ever engaging the United States or our allies.
I think a lot of, Tim, Americans might assume that, you can just sort of flip a switch, right, and build as many weapons and weapon systems as you need. Is it that simple, Tim?
Now, I sure wish it was, Josh, but it's not. These weapons are actually incredibly complex. They look straightforward and simple, but the electronics, the software, the control systems, again, they're designed to go after some pretty capable missiles that are coming your way, that are evolving rapidly. And so what we have to do is we have to ramp up thousands of suppliers, tens of thousands of components. We have to get commodities out there, such as titanium, where we go fight with the commercial industry over because it's used in a lot of commercial applications. And we have to build all the facilities to do that. And so to build these kind of complex systems, it takes time. Now, we are partnered with the Department of War, who understands this particular difficulty, and they're doing everything they can with us to find what we can do to compress those timelines down, to reduce testing, to reduce certification, to use AI and robotics to do things faster. So we're going to get faster and faster and better at this, so that while it isn't a quick flip of the switch to go faster, it also doesn't take us years and years and years like it might have before.
I'm curious, though, Tim, as you try to pinpoint, potential bottlenecks bottlenecks for you all when you're designing and then making systems like this. What would you say those would be? I mean, is it the suppliers? Is it the labor? Is it the materials? Is it all three, Tim?
Well, it has potential to be any of those things because it just takes one component that you can't get and you can't finish the missile because you need all the parts. But fundamentally, we are looking at and working with our supply chain to identify all of those. So where it's raw materials, we're out working with the Department of War to make sure we have a steady supply and an increasing supply of raw materials. Where it is a small subcontractor who just builds specialized parts for us, how do we get them in again, partnership with the Department of War, the finance they need, the urgency and support for investment that they need so they can build up rapidly. Sometimes it's a finished component, so it's getting ahead on mixers for propellant, for example, for solid rocket motors, or more test stands for seekers, for example. But we have already committed over $1 billion ahead of the contracts in investment, and we're on our way to $9 billion of investment from Lockheed Martin alone to do exactly what I just described, to find every bottleneck and to crush it before it becomes something that stops us from going faster.
Finally, Tim, you all are involved in Golden Dome as well, this missile defense shield over the U.S. Reuters reporting the projected price tag for that now around $185 billion. When your friends and family, they ask you about this, Tim, and they ask you, hey, Tim, why is this so necessary? And why is it necessary now? And will it work? What do you say, Tim?
Well, I think that why it's necessary is the United States ought to have the capability to defend itself against everything from a low-end cruise missile or a drone all the way up to the most advanced ballistic missiles that might be sent our way. And so it's something that you can just imagine. To have no defense of that isn't a great place to be. And so that's the fundamental why, to be able to protect our cities, our bases, our fundamental infrastructure. Will it work? Well, we know that there's elements of it that work already. So clearly THAAD is incredibly effective. It's demonstrated that in the last probably 12 to 14 months. PAC-3 MSE, very, very effective. We have laser systems and command and control systems that are deployed, very, very effective. And so in many ways, Golden Dome can be an assemblage of some very, very effective systems that allows it to go fast. Then there are some new technologies that the U.S. government has talked about, such as space-based interceptors. They're going to take a little more work, but with some innovation and some urgency, I think we have a really good chance of getting those on orbit pretty quickly as well. And so clearly a system that is almost self-evident in its necessity to have defense for the homeland, but also, I think, something that is not relying upon science fiction kind of technologies. Many of them are already here and working, and others are just maybe a few short months or years away.
Tim, so good to have you on the show today. Appreciate your time. Thank you.
Thank you, Josh, for having me. Appreciate it.
Hello and welcome to Asking for a Trend. Well, summer jobs for teens seemingly becoming increasingly scarce as employers tighten hiring, reshaping a long-standing rite of passage. Jean Yan, senior economist at Revelio Labs, joins now for a closer look. Jean, so you note that teen unemployment is sitting here around 15%. Frame that for us, Jean. How elevated is that, sort of historically speaking?
Yeah, I think if we're looking at the teenager unemployment rate, it's been trending upward since the end of pandemic, and right now it's sitting around 15%, right? Because when we think about teenager summer jobs, there's always a narrative about like maybe these teenagers these days aren't just the ones from the previous generations. Maybe they just don't want to work summer jobs anymore and prioritizing other activities during summertime. But the unemployment rate is really showing the other story. These are really the teenagers that are actively looking for jobs and cannot find them. And 15% is a quite high number. It's way higher than the headline unemployment number for the overall workforce. So there's definitely a big issue here.
Can I ask you, Jean, where would some of the bright spots be for teen hiring? What some of the sectors they should be looking at?
Yeah, so using our job postings data, comparing April and May summer hires with the last year summer postings numbers, we're finding that the bright spot really lies in retail. For example, for retail associate positions, we're looking at an increase from 2% last year to around 9% this year. So you might find a better luck looking at some of the retail related roles this year if you really want to find a summer job.
I'm just curious, Jean, fuel prices, geopolitical uncertainty, inflation, how, if at all, do you think that's impacting small businesses, seasonal hiring for this summer?
Yeah, it's definitely impacting their hiring plan by quite a lot, right? These are small businesses that we're talking about here. I'm sure their balance sheet and the calculations like super meticulous and just super tight. So they really are planning ahead with these hiring numbers, but just with all the uncertainties that are going on in the labor market, they're really having a hard time planning, and that's why we're seeing a lot more cautious planning when it comes to hiring. And I think first thing that they would want to look at is these seasonal jobs.
Should we think of teen hiring, Jean, is it ever kind of an early warning signal about the broader labor market, or no, these are different dynamics?
Yeah, I think, based on our previous studies, this is mirroring what we're seeing in the entry-level labor market. And the reason why I'm talking about these entry-level positions, mostly for, recent college graduates, is there is a spillover effect, right? If the graduate labor market is weak and they can't find, the typical data analyst, software engineering positions, these college graduates are going to be more willing to take on more retail, service, part-time, or even temp jobs that are traditionally more accessible to teenagers. So I think, it's definitely not a standalone labor market when we talk about teenager summer hirings. It is part of the broader trend that we're seeing in a much weaker entry-level labor market.
Given that, Jean, I'm just curious, do you see any data suggesting that recent college grads are actually competing with teenagers for jobs?
Yeah. So when we looked at, 2025 graduating cohort and looked at their kind of job placement, what we're seeing here is only a little over a third of them are both graduating and starting a job in the same year. And among those that actually find jobs, I think a little over a third of them actually find jobs that are matching their major or field of studies. So there's definitely like a mismatch in terms of employment when it comes to college graduates. And I think some of them are kind of going down a little bit and looking for more retail service-oriented jobs instead.
Gene, I'm also curious about the role of AI here and how you all are thinking about it. How is that impacting, Gene, how companies are thinking about whether even to hire junior workers and what kind of junior workers to hire?
Yeah, when we talk about junior hirings, there's no way that we can avoid AI. There's a lot of uncertainty around the AI or the impact of AI on the labor market, and that's what we're seeing here. Is I think it's less of a right away companies are finding all these technology to really replace what they should be hiring for these junior positions. Rather, they're just kind of on a pause and assess the impact before they can make any hiring positions. And we're definitely seeing that showing up in our data, especially in jobs that are highly exposed to AI technologies. That's where we see the demand drop the most. So I think, yeah, employers are definitely very cautious when it comes to hiring junior positions. Another interesting trend, Josh, that we found in the data is that instead of relying on entry-level kind of hires, we are seeing companies looking for more experienced, older workers to fill some of the positions. So yeah, I think it's definitely going to have some repercussion in the future if all these entry-level jobs are going to be disappearing soon.
Gene, one other stat that jumped out at me, something like 37%, just 37% of the 2025 graduating class both graduated and then it sounds like start a job in the same year. What does that sort of suggest about the kind of school to work pipeline?
Yeah, I think at this point, I think it's a little bit broken. So especially with education as like a long-term investment, right? Like you have to commit to a major way before you graduate. And by the time you graduate, especially with all the AI and different technologies coming out, we know that the labor market is just changing almost, not yearly, but like on a monthly basis at this point. But then you're committed to something that will have an impact a few years down the road. And we're seeing that, there's a lot of mismatch in terms of like, what are the majors that are actually going to get you jobs? And those are some of the information that we think we should share with college graduates early so that they can be prepared and make those, the right decisions before they graduate into a labor market.
All right, Gene, thanks so much for your time today. Appreciate it.
Thank you. Bye, Josh.
Coming up, how one Italian restaurant is capitalizing on a shout out from the rapper Drake. That's next on Ask for a Trend.
Italian restaurant chain Serafina got a shout out on Drake's new album, and the company has served up a response.
Drake dropped the name, we felt the love. Lobster ravioli, blessed from above. Grazia Drizzy, you already know.
What has been the reaction to that being within the album, and what sort of buzz has this created for the business?
I have to tell you, we are selling lobster ravioli like crazy.
Are you?
Yes, but to have a spike in reservation, I didn't felt it yet, or we don't have numbers yet for that. But we know the lobster ravioli is selling because they are sold out. The chef told me, we're making lobster ravioli all the time.
Did you have enough inventory going into this? Did you know that this was happening?
But no, they make them every day. They make them fresh every day.
Right. So
there's a guy
ramping up orders
with gigantic ants making lobster ravioli over lobster ravioli over lobster ravioli.
Is this across all your locations that you're seeing?
Across all the locations. In Miami, our partner in Miami, we have two restaurants in Miami, and our partner in Miami is telling that he saw a big spikes in reservation. Wow. Here, honestly, I just see selling more lobster ravioli than
more people going for that
specific item. Yes.
I do want to talk sort of big picture, because you have been in this business for so long, and now we're in this sort of environment where we're hearing so much about the impact that these fuel costs are having on input costs, as well as packaging costs, and then transportation costs too. So, what are you seeing in your business? What do you even compare this to?
Well, my partner Fabio and myself spend a lot of time buying ingredients. We buy only the best quality ingredient, top quality ingredient. In Italy, we tour Italy 3-4 times a year.
Wow.
We visit all of our purveyor, and when we are there, we check the quality to be the best, and we negotiate any possible price increase. I have to tell you that since a year, we are not raising our prices. We are eating the difference of the effect of the inflation. And more than anything, we are buying in such a large volume that we have a buying power with our producer in Italy. Part they are eating for the increase, and we are eating locally. So our prices are the same since a year in the menu. It's a problem, however.
What is you're saying you don't want to raise prices, or do you feel like right now you have the pricing power to sort of negotiate and do that, but yet do you just feel like consumers can't take on higher prices right now?
No, I don't think they can. I mean, we try to be as reasonably for the quality of ingredient that we use as we can. However, I have to tell you that we buy this meat called Double R Ranch, which is a Snake River Farm ranch, probably the best quality meat, or one of the best quality meat in America. And like a month ago, all of a sudden, they raised the price of the steak $6 a pound, $7 a pound on us. I mean, one day overnight. And I mean,
what did they allude to? Because we've been hearing about that low cattle supply for years, affecting the overall steak and beef market, hot dogs even.
Yeah, no, the price of the hamburger went ballistic because the administration put a 50% tax on Brazil. All hamburgers are coming from Brazil, and therefore, but the steak are all local, all Northwest, as an idea, the quality steak.
On top of the food costs that we're seeing are higher, you have also been known to say, you did say once that labor costs are also quite high in New York.
Yeah, labor cost is spiking up, unfortunately, and now, I mean, the new administration is talking about raising above the limit at $30 per hour. All the food and beverage industry at $30 per hour would be out of business. We can afford.
So what's your advice there to maybe entrepreneurs who are looking to take off like you started?
I don't know. Computer, AI, robotics.
But that's not impossible, maybe.
Robotics.
I mean, would you have robots in the back of the house?
You know, we study actually with a company in China that makes but it's so prehistoric, so primitive. The idea of the robotic for making pasta is like a washing machine, 6 washing machine online.
Oh my!
But I guess we are not there with the machine that actually take the pan, saute the pasta. We're not there. We're getting there. One day soon.
So you still have a full humans back in the house.
But the human are better, honestly. There is a sensitivity, there is a love, hopefully, in what they're doing. I mean,
I totally agree.
And chefs should taste, every time you make a sauce, every time you make a dish.
Yeah.
But
make sure it's good quality.
Yeah,
you also are expanding rapidly. You now have many international locations. You're also launching new concepts.
But
what has that been like?
We just launched a new restaurant called Cognac on 40th and 5th Avenue. Beautiful.
Is that also Italian concept as well?
French American. Is a big brasserie on Bryant Park. Phenomenal, so beautiful. I mean,
and it's performing well?
Yeah, but we opened 2 days ago. So
okay. All right, so we'll have to try it out.
I mean,
just open.
Guys, come and try it. You love it. But we are opening international, yes. We are planning a new location in Japan. Wow. We have several in Tokyo. Now we are opening in Osaka. We just opened in Marbella. In Spain. I'm leaving to Morocco for Marrakesh. There is a new location coming. Where we are opening international. But I guess in New York we are planning 2 more locations. I am a true New York believer. I saw different economic cycle coming in New York, and I believe New York is resilient, meaning sooner or later, however it's difficult, Monday and Friday are difficult days in New York. Everybody work remote, people take off on Thursday night, they come back on Tuesday. I mean, the impact is big on my industry.
Interesting. Now, elsewhere, are you seeing that trend maybe be?
No, in Milano doesn't exist. Everybody work 5 days. In Japan, everybody work 5 days. I mean, in many parts of the world, people work 5 days, but in New York, not yet. I mean, I hope we are going back soon to the 5 days, 5 business days, because in our industry, we feel it.
Wow, that's interesting.
We really feel it.
What are you hearing that from others within New York City as well?
Yeah, but we have 26 locations in New York, so we feel it.
Okay.
And then I have so many friends in the industry that I know. I'm friends with the biggest restaurateur in town, and for all of them, Friday and Monday are critical. I mean.
When you think about right now, just get back to where we are with wages. Right now, wages are increasing less than inflation. When you hear that headline, I mean, are you worried at all about the consumer dining out? Who is your consumer that's dining out?
I'm afraid, because right now the minimum wage is $16, $17 an hour. In reality, tipping employees which make the majority of our employees are working on a $12, $13 basis because they make tips.
Right.
But now there is a proposal of the new mayor, Mandami, that is suggesting $30 per hour. $30 per hour, my industry will be bankrupt. I mean, period.
Are you
as simple as
noticing
that.
your customer, maybe is there a higher income customer coming to you right now? Are the low income consumers maybe pulling back, less tourists?
Serafina is a special concept. If you divide the consumers in a pyramid, we touch only the top of the pyramid since the beginning. For the level of ingredients, because we born on the Upper East Side on a way 30 years ago. But our clients on a way are a special breed of clients. Even if we're a regular Italian restaurant, but again, for the type of ingredient that we use, for the how cool the place, how fun are the place. I mean, we target the top of the pyramid. So on the top of the pyramid, you feel a little bit less the impact of the inflation, of the raising the cost. I mean,
higher
but still,
again,
I refuse to raise prices to my clients. I think we reached the limit. I mean.
Reach the limit. You heard it here.
Yeah, we reached the limit.
Great point. Vittorio Sepp, thank you so much. We'll have to try the lobster ravioli. We'll have to go to Bryant Park to try the new concept. I think we have a food tour on the way.
A lobster ravioli everywhere.
Lobster ravioli everywhere.
I want to go to see Drake with a gigantic box of ravioli.
All right, you heard it here first, Drake. If you're listening, let us
Drake,
know. We're ready to come.
Yeah, Drake, I need to come to see you with a humongous box of lobster ravioli. I'm preparing it.
Vittorio, I love that. Drake, you heard it here first.
Yeah.
Thank you so much.
Thank you, Drake. Thank you.
Time now for To Watch Wednesday, May 27th. We've got a big day of tech earnings ahead, giving investors a read on everything from AI demand to enterprise spending and the health of the PC market. Starting here with Salesforce, investors will be watching for signs of a slowdown in new contract signings. Analysts flagging macro uncertainty as a potential headwind. Same time, Salesforce is ramping AI investment, which could pressure margins in the near term. Over to Marvell, where the story is about data centers and AI infrastructure. Analysts expecting results to come in above consensus, driven by strong demand for custom chips. Investors waiting to see if Marvell can sustain momentum as hyperscalers build out AI capacity. Taking a look over at Snowflake as well, the software bellwether announced results after the markets close on Wednesday. Analysts are looking for signs that AI workloads are driving meaningful growth on the platform. And finally, HP Inc. Analysts anticipating the outlook to be pressured by weak PC demand and rising memory costs, warning a potential downside of earnings expectations with limited relief in the second half. That's a wrap on today's show. Thanks for watching.